Hello and a warm welcome to Econoday Unplugged on Tuesday, the 1st of March 2022. Terry Sheehan is on the US East Coast, Max Sato's in British Columbia, and I'm Jeremy Hawkins in London. Brian Jackson's also in Sydney, but sadly COVID has caught up with him and he'll be missing the podcast this time round, so get well soon, Brian. Well, 6 days after Russian troops and artillery moved across the border into Ukraine, investors are still trying to determine the likely fallout for the global economy and financial markets. The sanctions levied by the West immediately after the invasion were generally seen as only light and unlikely to have much impact. In fact, they even prompted a relief rally in stocks on Friday. However, the weekend's announcement of an unprecedented raft of economic and financial measures, including sanctioning the central bank of Russia and barring a number of major Russian banks from the SWIFT global payment system, has real teeth. It's likely to hit the Russian economy hard and quickly. Indeed, Monday saw a dramatic run on the ruble that forced the central bank to more than double its benchmark interest rate to some 20%. President Putin has put his country's so-called nuclear deterrence forces on alert, and the EU has closed its airspace to all Russian traffic. Significantly too, by more than doubling its defence budget to arm the Ukrainian forces, Germany has undertaken a major U-turn on its defence policy. And just yesterday, Switzerland said it would adopt all the sanctions proposed by the European Union, abandoning its long-held tradition of neutrality. All of which means that as Russian tanks move in on Kyiv, the crisis continues to escalate. On the positive side, so far, global financial conditions have deteriorated to only a limited degree, and corporate bond spreads over treasuries have similarly widened by nothing like the extent seen when COVID arrived back in 2020, let alone during the global financial crisis. Nonetheless, war means added downside risk to the global economic growth picture and the near certainty of yet higher inflation. Not surprisingly then, financial markets remain highly volatile and risk averse as the outlook for central bank policy becomes all the more complicated. So let's have a look at how the latest developments might impact the countries covered by Econoday's economics team. Terry, then, US has made it pretty clear what it thinks about the invasion, but what do you think it all means for the US economy?
Well, the early indications before the invasion were that the first quarter 2022 was going to be on the softer side than we saw. It's certainly now a much bigger risk to the outlook, especially with inflation clearly suffering another blow here for the US, and the anticipation of even higher energy prices. But the early indications are from the January and February surveys of manufacturing and service sector activity is that things seem to be going along on a modest to moderate pace. So hopefully there'll be a little momentum there to carry us over into March and set up the first quarter for at least decent growth.
Okay, let me ask you about the FOMC then. Clearly, we talked on previous podcasts about speculation of as much as a 50 basis point hike in March. I guess the key questions there are: one, are interest rates still going up in March? And two, is there any chance now that they'll do as much as 50 basis points?
I would say it's a near certainty that they will do a 25 basis point increase. I think 50 basis points has become problematic with a riskier outlook. I think they're going to have to take a much more cautious approach to removing accommodation. We know that the asset purchase program is winding down early this month. Tomorrow and Thursday, we're going to hear from Fed Chair Jerome Powell in his semi-annual monetary policy testimony. We are anxiously awaiting his prepared remarks, which will be out very early tomorrow morning, before the start of the testimony. He almost certainly has to take into account what's going on with Ukraine, and will almost certainly sound a much more cautious note about removal of interest rate accommodation. And the other thing is, we're in the upcoming FOMC meeting. This is one of the quarterly meetings at which they update their forecasts. So we are going to be anxiously awaiting those too.
Interesting. And let me ask you, I know previously you've chatted a bit about the exchange rate and it not being the be all or end all for Fed policy by any stretch of imagination. But we are seeing the dollar rally pretty sharply at the moment on the back of what's happening in Ukraine. Does the stronger dollar have any implications for the speed or the extent you think that the Fed funds rate might be hiked during the course of this year?
Well, they certainly have to take into account any fundamental changes in how the economy is running. But they're very cautious about doing anything that would imply that they are taking into account fluctuations in foreign exchange rates. So while it is certainly a point that will be discussed, it's not going to be in the forefront of any reasoning behind any change in rates.
Okay, fair enough. Now, you mentioned that Jay Powell's will be doing a couple of speeches during the course of this week. Tonight, of course, we have the State of the Union address. So how important do you think it's going to be for shaping US policy and indeed, ultimately, for the position of Joe Biden himself?
Well, I mean, events have been happening so rapidly over the last few days, and the actions taken by various governments that you talked about at the start, many similar things have been done by the US. I think we're going to get something that's a more definitive policy statement tonight in regard to the US response to the invasion of Ukraine. This is probably a good chance for Biden to sort of reset his public image. A lot of the criticism he's been facing has been that his response has been weak or ineffective. And I think this is going to be his chance to push back on that.
Hey, watch this space, as they say. And certainly,
Yeah.
in terms of my questioning you, last one I've got to ask, of course, it's US employment week. Are we expecting another strong report this week, or are we looking for something a bit softer, or how do you think it's going to come in?
The Econoday median forecast, last I looked, was around 390,000 increase in non-farm payrolls. It's a pretty good increase. There's also there were a number of mandated increases in minimum wage that went into effect in January. So we're likely to see the impact of those in the February data. And generally, things like initial jobless claims have been remaining quite low. So to all indications, this should be a solid employment report.
So nothing to watch that might dent prospects for a rate hike in March?
I don't think so. I was doing a little preliminary work on the historical trends with the February report. And in fact, it tends to be a pretty good report that doesn't suffer a lot of subsequent revision. And it does tend to come in slightly below market expectations, but anything above 300,000 is going to be viewed as a decent report.
Good number, yeah. Okay, that's great. Well, that's my questions, Terry. Anything else you'd like to put into the old pot?
No, I think we're just kind of holding our breath here and waiting for developments.
Yeah. Not a great time at the moment. Okay, great. Thanks, Terry. Okay, Mr. Sato talked about Fed. Well, of course, you can preempt them because you've got a Bank of Canada meeting tomorrow. Interest rate hike then has been widely expected for a while now. Is that still the case?
Yes, I think it's pretty much a done deal. The governor has been saying we're on a rising path, and which means he said it's going to be multiple rate hikes. So I think what he's trying to say is this excess monetary easing is no longer necessary because supply and demand are largely balanced. And remember, back in March 2020, the Bank of Canada conducted 3 rate cuts totaling 75 basis points. So it's basically a process of unwinding the emergency monetary easing. And on top of that, the focus is also on whether banks going to actually stop reinvesting in government of Canada bonds that they hold on their balance sheet.
Because at the moment, they're still holding balance sheet flat, aren't they?
That's right, yeah. So previously they said they'll consider whether to let the balance sheet shrink as they start raising interest rates. So, but it's not clear exactly what timing. So if not tomorrow, we definitely will see it in April, I think.
Okay. Now, clearly, Canada and commodities go hand in hand with each other. So what's happening in Ukraine potentially has some significant implications for what's going to happen on your side of the water. So what do you think the Bank of Canada might say about the Ukraine effects, if you like, in terms of policy when we get the announcement tomorrow?
I'm not sure any central bankers will comment on the political or diplomatic implications, but I think we can safely say all the central banks are concerned about the global impact, regional, European, not just regional, but any slowdown on global growth, and also, of course, the higher energy and commodity prices on concerns of supply disruption going to further undermine the business and consumer sentiment. So indirect impact may be there, but I'm not sure whether the Bank of Canada can clearly measure the extent of such impact at this moment.
Yeah, very unclear at the moment. In terms of the growth numbers, I saw you had fourth quarter growth out earlier on today, which I guess was pretty strong and suggests that the economy itself had plenty of momentum going into the current quarter.
That's right. 6.7 annual rate, which is largely expected, but yes, strong on the strong side. And then what is interesting is StatsCan's preliminary estimate for January is 0.2% rise, despite the Omicron storm for that month. So that bodes really well, and it's probably a relief for the Bank of Canada people.
I guess, as you say, given that the Omicron, what one would assume to be a fairly significant Omicron effect in that month, as you know, it suggests perhaps we could see a relatively strong, or certainly stronger than currently expected number for the first quarter, which again, very much in line with perhaps a run of rate hikes as we go through the year.
Right. I think I believe my guess is people are beginning to learn how to live with COVID. And this on and off, stop and go restrictions and reopening. I think business and households are trying to live with it, and then that's why maybe the GDP may not be hurt so much in January.
Okay. Any else from your side, Max, on Canada?
I think that's it for now.
Okay. Thanks muchly for that. We're back for you in Japan in a minute, but let's move across to Europe now. Right. Well, as we talked about in the last podcast, Ukraine events, of course, are much more significant for Europe, with it being that much more exposed both geographically and financially, and of course, particularly in terms of energy supplies. But remember, too, that Russia is also a major producer of a number of raw materials, including the likes of nickel, copper, iron, platinum, palladium, neon and agricultural products, too. So what happens there is going to have potentially far-reaching implications as far as inflation goes across the European continent. On that, at least with regards to that, the ECB meet next week for their March meeting, and it's interesting looking at how financial markets really have pulled back quite significantly in terms of their rate hike expectations for 2022. We go back 2 or 3 weeks ago, the talk really was that we could see key interest rates in the Eurozone up by the best part of 50 basis points, if not more, by the end of this year. That's probably been pared back to about half that amount now. And even then, it's far from certain what the ECB is going to say next week in terms of just how hawkish it's going to sound. The February meeting rang alarm bells over inflation, and that very much got investors looking towards higher interest rates across Europe. But clearly, the Ukraine effect remains to be resolved and undetermined. And also, it appears from what we have available at the moment to be just widening some of the splits we've talked about in the past on the ECB governing council. The likes of Austria, one of the mega hawks there, the central bank chief Holzmann, he's talking about 2 rate hikes this year, with the first move in summer and eventually moving up to a neutral rate of 1.5%. But against that, we've had the Greek governor suggesting that he thinks asset purchases should be extended right through the end of this year to try and cushion the fallout from the conflict. The Portuguese central bank has warning now about possible stagflation. So it's going to be a very interesting meeting next week to see how they come out with some kind of compromise statement which encapsulates all the various views from the governing council members. Interestingly, I don't know, I guess not too many central banks have really come out with any kind of estimates of just what the damage might be done to their economies from the Ukraine war. And clearly there's such uncertainty surround that at the moment. It's hard to attach much weight to any number anyway. But just for reference sake, Philip Lane, the chief economist of the European Central Bank, he was interviewed a couple of days ago and suggesting that on a kind of a middle assumption, whatever that really means, the Eurozone's economic output could be hit by between about 0.3 and 0.4% this year. And indeed, if a situation is actually worse than a central case scenario, you could take a full 1 percentage point off GDP. So that's kind of back of the envelope stuff at the moment, but it's something to bear in mind because it is going to be important for growth. In terms of the actual numbers we've had, by and large, the first quarter economy at the moment looks to be holding up relatively high. Economy's ECDI has been running in positive numbers, quite comfortably in positive numbers for a little while now. So if anything, at least prior to the Ukraine invasion, it looks as if the economy in the first quarter might well exceed original expectations, which of course would bolster the idea that interest rates might have to go up before the back end of this year. Also, in line with that, we've had high inflation. The January inflation number came in at 5.1% after 5.0% last time, and that was expected to decline. Even if we strip out some of these tax effects, we're clearly seeing an ongoing upward trend in headline inflation. At constant taxes, we have a Eurozone inflation at 5.2%. That was January figure, up from 4.5% last time round. So it looks as if the trend very much heading the wrong direction for the central bank. And tomorrow, when we get the February flash data, markets looking for a small increase there on the headline number up to 5.3%. But from the increases we've already seen coming out of the big four, so that's France, Germany, Italy and Spain, it looks as if there's going to be upside risk to that. So the hawks on the ECB aren't going to be happy. They're going to want to see policy being made less accommodative still, I suspect, as soon as possible. But the doves, especially in the context of what's happening in Ukraine, are very much going to be pushing for no kind of changes. So there's going to be a lot to look at when we get to next Thursday, and there could be some significant moves for financial markets to come out of that. In terms of the UK, well, apart from the inevitable effects of Ukraine, which similarly has helped to dampen expectations for Bank of England rate hikes this year, markets are still very much expecting the bank to deliver a number of interest rate hikes, and probably the next 25 basis point increase coming through at the meeting, just over a couple of weeks' time now, but certainly not quite as aggressive hikes in interest rates anticipated now than they were before the invasion took place. Indeed, we've had a number of Bank of England members, MPC members, including the governor, really pushing back against what had been very aggressive market speculation on the rate hike front. Indeed, going out of their way to point out that we go back a couple of weeks or so ago, markets were looking for bank rate to be up around 2% or so by the end of the forecast period. The bank keen to point out, well, on their basis, that would put inflation at just 1.4% in 3 years' time, so well below target, and just emphasising the fact that they thought such speculation was too high. Nonetheless, rates are going to go up by the looks of it in the UK, and it's still a question of how much and how quickly. Okay, then what else have we got from the UK? Not really too much, but I suppose it's just worth mentioning some of the PMIs we've had just out of Europe in general. One or two of them have actually referred to Ukraine as having some kind of a slight denting effect on overall confidence. By and large, the business sentiment about the year ahead continued to remain at, what should we say, elevated levels, and perhaps even go up a little bit. At least one or two of them were starting to touch on the potential negative effects of Ukraine. So that's something to look out for in coming PMI surveys. And indeed, of course, because it's going to take time for the hard data to actually reflect the impact of what's going on in that part of the world, these consumer and business surveys are going to be key indicators as far as the market's concerned. I mentioned Switzerland in the intro on their decision to move away from their standard neutrality stance. Also worth mentioning them just because what's happened to the Swiss franc at the moment. That is, as ever, re-emphasizing its position as being the #1 safe haven currency as far as Europe's concerned. We've seen Euro Swiss falling to levels that we haven't seen since the Swiss National Bank unplugged its target floor for the currency back in January 2015. And it looks as if a possible test of parity against the euro could be on the cards if this all the fallout from the invasion continues as seems probable at the moment. Okay, that's it. I think probably as far as the European roundup. Max, if I can come back to you on Japan, what's happening in that part of the world? What should we be looking at?
Okay, Jeremy, there's a lot to talk about right now. First of all, I think Toyota and its group is back on track, but there was disturbing news from that part of the sector. Toyota said that was on Monday that it would suspend all domestic factory operations on Tuesday, which is done, and now they're back. But that's because one of its key parts suppliers was hit by a suspected cyber attack, and the timing was it's discussed by media and social media that it is a retaliation from Moscow for Tokyo joining its allies in imposing further economic sanctions. We never know, but it really shows you how efficient just-in-time production delivery systems used by Toyota can be pretty messy when in a crisis. And it's not prolonged, so that's okay, but this could actually reduce the production number for this month. And talking about industrial production, there are sort of conflicting signs after the Delta variant hit Southeast Asia, and Japan was hit because Southeast Asian factories are down. So parts supplies was further delayed. But then they said there are signs of easing disruptions. So industrial production actually rebounded in October, November. But now, December and January, it's down again, and they're talking about semiconductor shortages for the car industry. So this may be not just from the domestic side, but if you take a look at the Bank of Japan's real trade indexes, real exports for January were down 1.5% from the previous month. That's a second decline in a row. And especially the auto sector index was down 7% after rising 2.8, and capital goods index was down 6.6. This is a second straight monthly decline. It may be that there was a huge reopening demand earlier, but that may be slowing globally. The only regionally bright spot was the EU, up 7.8, while exports to the US were down 5.6 in this Bank of Japan's measure. So what it means going forward is even though the direct impact of the economic sanctions against Moscow may be limited for Japan in terms of a direct trade with Russia, which is only Japan's exports to Russia last year was only 1% of the total. But then Japan still imports about 10% of its LNG from Russia, although Japan relies heavily on Australia, Malaysia, and Qatar, which altogether comes to 60% of its total needs. That's fine, but if European growth slows because of the conflict in the region, that could hurt the slowly recovering demand from Europe for Japanese exports. So that might be concerning. And if you take a look at Japan's dependence on commodities, auto and electric industries bracing for a possible worsening of global supply chain again, because Russia is the world's largest producer of palladium, which is a key component in emissions reducing devices and also making computer chips. And on top of that, of course, Russia is a major player in top suppliers of canola, corn, and wheat. And Japan's heavily dependent on those commodities. So there is still an unknown while Japan was hit by a sixth wave of a pandemic, mostly in January. And I don't know why the number is still rising, just like in Korea, compared to receding numbers in the US and Canada. So this may be a problem for this current going forward, current quarter, I mean.
Okay, excellent. Thanks for that, Max. Right, well, let me, in the absence of Brian, then round off just some of the bits and pieces, what he would have been talking about. I've got to mention China. I guess we should say at this stage, as far as the People's Bank of China is concerned, they've yet to really disclose how they're going to respond to the various Russian sanctions and so on. But earlier on today, the Chinese government did signal that it's ready to play a role in finding a ceasefire in the Ukraine war, as to quote, it deplored the outbreak of conflict in what really amounts to its strongest comments on Russia's since the invasion began. That could be important because quite clearly, Chinese politics is something that financial markets have been concentrating upon for some time now, and the outcome of the war in Ukraine might well have some say in how China pursues its goal of reunification with Taiwan. Should Putin emerge a winner, China might be encouraged to test the waters with Taiwan that much earlier than otherwise. But ultimately, I guess we could see what's happening currently is either an opportunity for China to go into Taiwan, or ultimately perhaps completely the other way and improve its relations to the US. So either way, there could be some radical implications for that part of the world as well. Out of Australia, we had no change from the Reserve Bank of Australia today, and they indicated that the May meeting will review what they're going to do with their 350 billion Australian dollars worth of quantitative easing, how that will be unwound. Bottom line, as far as Australia, at least the RBA, they remain one of the most dovish of the central banks around the OECD. As far as they're concerned at this stage, they still seem to think that with inflation, the trim mean at the moment is currently 2.3%, so pretty well in the middle of their 2 to 3% target range. They're not convinced that there's enough evidence that wages are picking up enough to guarantee that it's going to stabilise within that region. So as far as they're concerned, they're still not looking for any kind of early move on interest rates. That said, Tuesday's statement did omit the previously long-held view that rates were unlikely to rise until 2023 or even 2024. So perhaps that's the first sign that they're gradually starting to move towards a less accommodative stance. They did actually mention Ukraine, though, interestingly, in the statement, which, although albeit they just mentioned it could be a major new source of uncertainty, and also noted that the situation was really forcing commodity prices to move higher. Lastly, I mentioned the Reserve Bank of New Zealand, which since our last meeting, at least last podcast, I should say, they've hiked interest rates again, up another 25 basis points to 1% on their official cash rate. That's their third increase since October. And also, they certainly at that stage anyway remained very hawkish, indicating that there's a possibility of a bigger hike, perhaps as soon as the May meeting. Also indicated that the start of quantitative tightening via runoff in and also net asset sales will be starting in July time. So look around the world at the moment, amongst the most hawkish of the central banks, the RBNZ probably stands out. Okay, then. Anyone else for anything else before we round it up?
Hi, Jeremy. I have a question for you.
Yeah, please.
If you take a look at the Bank of Russia statement, the central bank and the government there, they're really trying to mitigate the impact of the sanctions on their currency, the value of the currency, and of course inflation and deposit rates. It sounded almost like the problem back in Japan in the late 90s when we had the housing corporation debt crisis. Do you think that could spill over to your region or global, other parts of the world?
It could do. I mean, I think you mentioned earlier on about one of the big issues at the moment now is going to be further problems for supply chains because Russia is so important in a number of different commodity areas. And indeed, I was reading an article today, I think, which suggested round about, is it 20%? At least 10%, between 10 and 20%, I think, of sailors in terms of the merchant ships come out of Russia. So presumably they could well now be barred from landing. And it's certainly the case. We've seen Russian ships already turned away from the UK, been turned away from some ports in Europe. So there are going to be knock-on implications for basically the world, I suspect, on the basis of what's happening in Ukraine at the moment. Some countries actually on your side of the water are going to be hit that much less than the likes of Central Europe. But Central Europe itself is clearly going to suffer some kind of fallout from this. And I guess markets at the moment, all this safe haven buying is part of the reflection of the fact they don't really know what's going to go on. But for Russia, looking at the magnitude of the sanctions which have been introduced by all the big countries, be it US, be it the European Union, UK, or whatever, they do appear to be really significant. And if it is the case, as it seems, the Russian central bank only has very limited access now to its 630 billion or so of reserve assets, dollar assets, then it's going to make it extremely hard to try and protect the ruble without continuing hiking interest rates. And if it does that, the Russian economy is going to fall through the floor. And Russia buys a lot of goods out of the European Union and indeed to some extent out of the US as well. So it's going to be a major hole in terms of global demand. So sadly, I think however this thing pans out, the outlook for global growth has to be that much less than it would have been previously. And possibly for parts of Europe, notably for those countries where some banks and Italian banks and I think Belgian banks, which are quite heavily exposed to Russia, the fallout there could be that much more. So I think, markets perhaps they've wound back some of their expectations in terms of interest rate hikes. But if this thing rumbles on, for a long while, there's been talk about, as I mentioned, from the ECB about stagflation. There could even be the possibility of the third global recession in not a very long time, which wouldn't be too nice. So it's anybody's guess how this is going to pan out. But the very short answer to your question, having rambled on for the last 5 minutes, is yes. Right.
But then, so, but you don't expect a huge impact like what we had when Lehman collapsed and credit crunch everywhere. And
no, I don't. No, I mean, I don't. Certainly, it's got to be said. I mean, the exposure of European banks to Russia has been pared considerably over the course of the last 5 to 10 years or so. So exposures, I think, about 30 billion or so in some of the bigger banks, but it's nothing like the kind of problems we had in the debt markets going back to the global financial markets, as you mentioned, Lehman. No, we certainly won't get that coming through. I think it'll be much more to do with the kind of economic impact and the loss of demand.
Okay, thanks very much.
Right, thanks, Mac. Anything else from you, Terry?
Nothing here.
Good. Okay, then in that case, let us wrap it up for this podcast. Well, I suppose you've got to say that war in Europe is not something many people ever expect to be discussing this century. But anyway, here we are. Not a great time for the world economy, but it certainly could be some kind of turning point for Europe. In terms of economic numbers, as I mentioned, since we'll have to wait for the hard data to see just what kind of impact this thing's going to have, the confidence surveys, business and consumer confidence surveys, obviously the likes of the PMI and so on, will be the key indicators to watch. All those, of course, can be found and detailed and analysed in Econoday's global economic calendar, so do keep an eye on for that. On behalf of Terry, Max and myself, thanks as ever for listening, and we hope to see you next time. Bye for now.